hiring partners, making sure your agreement will work. Before we begin, we need to cover just a few very important things. First of all, please close any other programs that you have running on your computer. This will help to ensure quality presentation and reduce any audio issues that may come up. Transition Advisors is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you participate in all 3 of the polling questions that we'll have throughout the presentation today. Please note that GoToWebinar does monitor your participation in these polls. Next, I will be emailing you a link to an evaluation after the webinar ends, and this must be completed before we can email you your CPE certificate of completion. Once these requirements have been met, the certificate will be emailed to you within 10 working days. An additional very brief survey for this webinar will appear immediately after the session ends, so please take a moment to complete that before you close your browser. This survey is very important to us. It will help us provide you with quality information in future webinars. In order to fully participate in the webinar, please familiarize yourself with our GoToWebinar control panel. It should be on the right-hand side of your screen. The orange arrow at the top of the panel is to minimize it. During the presentation, everyone is muted, but you can communicate with us by using the question box, which is toward the bottom of the panel. Just type your question in the box and click send. Questions are very important to us, and obviously we want to address your concerns. Our presenter, Terry, will be answering your questions during the presentation. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Some of our upcoming topics include valuing your firm, new practice niches, and internal succession. You can see a list as well as the dates here, and a complete list of the webinars, including links to register for them, is on the CPE courses section of transitionadvisors.com. Finally, if you'd like a hard copy of today's presentation, you can request it through the survey that will pop up in your browser after the presentation, and I can email that to you. You can also email me with any questions. You see my email address there, and you can also reach me just by replying to any of the reminder emails that you've received. Now I'll go ahead and introduce our presenter for today's session. We have Terry Putney, who is the CEO of Transition Advisors. Thank you very much, and I hope you enjoy the webinar.
Thanks, Nikki. Just a brief description of the firm in case you're not familiar with us. We are a national consulting firm. We work strictly with CPA firms on ownership transition issues, and that usually leads to the projects we're involved in being arranged mergers and acquisitions when that's necessary. We also work on succession plans for firms, oftentimes leading to new partnership agreements, and of course that's the focus of our presentation today. You can see some of the things that we're involved in this graphic. Vicki, I'm clicking on the, I'm not getting the, it's not moving. Okay. Just to give you a little brief description of the team members on our, for Transition Advisors is myself, Joel Senken, who's a very frequent speaker around the country. You may have heard other presentations by Joel. We both speak for state societies, the AICPA, and other groups like CCH and so forth. Bill Carlino, who's the former managing editor of Accounting Today, is our national director of consulting services. Vicki, you're going to have to advance the slides. It's not working for me to do it. Mark Bazinski, Russ Best, and Nancy Egan are all managing directors that work in various areas of the country. Next slide. Peggy Tyers manages all of our operations in Canada. Marcia Miller, Mike Farinelli, and Kay Conklin are all involved with also business development and managing projects for us. Next slide, please. You know, there's reasons why you might be here, things that you're looking for, things you're hoping that we address today. So what is it that was on your mind? Well, potentially you see partner retirement as a financial burden for you and for your firm. Potentially, you're wondering about whether there will be anybody down the road to buy you out. Maybe you're the youngest of 4 partners, and it looks like you'll be left holding the bag at the end, and there won't be anything left for you. Potentially, maybe you've worked for 35 years building your firm, and, well, am I going to get paid what it's worth? I've got to build up this tremendous value, and now is there anything, are my partners going to be willing to pay me? Or can you be surprised how many firms don't even have an agreement? Unless, of course, you're one of those firms that doesn't have an agreement, and as you'll find out, there's a significant number of CPA firms in the country that don't have agreements. Next slide, please. Maybe you look at the young people in your firm, and they've been terrific up to this point, but now you just can't imagine that they'll be running the whole show. Next slide, Nikki. And go on beyond that. Thank you. Sorry for the, we've got a little bit of a glitch here in our webinar presentation, so I apologize for the inconvenience of this. You know, your owner agreement defines the culture of your firm. I'll give you a very specific example. Can you go back, Nikki? For example, if your agreement pays partners in retirement based on their book of business, they're obviously going to tend to focus strictly on building their book of business and managing their book of business. And that kind of tends to create a silo type effect in the firm. It tends to create more of a collection of individual books of business as opposed to a cohesive firm. Now, there's a lot of firms that operate that way, and they operate very successfully. But if that isn't the kind of agreement or kind of firm culture that you want, needless to say, you've got the wrong agreement in place. You know, reading an owner agreement can provide a lot of insight into a firm's culture. You know, oftentimes when I get a partnership agreement, I'll read it. I'll see some things that may have been in place 20 years ago when the firm was first formed that are no longer consistent with the current culture of that firm. And that's, of course, can be a significant problem when a firm is trying to operate one way, and, of course, their agreement is dictating that they operate a different way. Next slide, please. You know, all too often, we sit here and we don't look at the owner agreement. We haven't looked at it for years. We maybe have looked at it and realized there was something wrong with it, but or maybe you don't even have an agreement, and then all of a sudden a partner comes in and says, you know what, this is my last year, my last tax season, I'd like to get bought out, and all of a sudden now we've got a problem because this agreement now has become real, or the need for an agreement has become real. And when that happens, next slide, please, some objective of the plan becomes solely financial. And I think we all remember Tom Cruise's Jerry Maguire, Show Me the Money, and I can't tell you how many times I've had firms come to me and say, we need some help with my agreement because, and then we get into the financial issues. I don't like the financial issues, they're not good enough, you know, something like that. When in fact, the real issue that they need to be focusing on is what really builds value in the firm. Next slide, please. So, you know, the proverbial putting the cart before the horse would be addressing the financial terms of the agreement before we really understand the business plan that creates the value that that agreement is based on and creates the basis for paying out a partner. Next slide, please. So today we're going to address first the principles of value in any CPA firm. Next click. A proper transition, which should be the first priority of your plan for succession. Assuring you have a strong internal succession team in place. And finally, making sure you've got the right financial arrangement, or making sure that the money comes out okay. Next slide, please. You know, the principles of value in a CPA firm, there's two basic components of value in any firm. One is the tangible value of the firm, which is generally the accrual basis book value, which can be, you know, looked on as well as liquidating value. So we've got, you know, typically accounts receivable, work in process, cash, some property and equipment. It depends on how old it is, but typically that's not given a lot of value. There may be some other assets, and of course you may have some liabilities in the form of bank debt or any other kinds of accruals. Next click, please. But the most of the value, of course, is going to be in the intangible value of the firm, which is made up of the clients, the employees, the name, the goodwill, all the things that make up the actual business itself. And of course, in a CPA firm, this is all walks out the door every day. So the intangible value is really difficult to get your arms around, but it's also where most of the value resides. In most firms, the intangible value is going to be anywhere from 3 to 6 times the tangible value. Next slide, please. So the common theory most of us carry around is that, well, my CPA firm is worth 1 times revenue, and of course that's usually the tangible values in addition to that. Or if you've got a firm whose internal agreement calls for value to be determined based on compensation, 3 times compensation. Most of us think, well, that's just what a firm's worth. Next click, please. But the reality is that the intangible value is really based on a buyer's expectation of future results. And those results can vary dramatically based on the business plan that's put in place either in an external deal or an internal deal. So how much would you pay if you were a buyer of a firm where you were uncertain about how many of the clients you could retain after the acquisition? You probably wouldn't pay very much. Therefore, if you're in an internal deal, how much should you pay for a retiring partner interest in a firm if you're uncertain about all the relationships that partner controls and whether or not those can be retained? So there's really no basis for assumption that a firm's worth anything until you understand how the firm's relationships and duties for a partner or for all the partners is going to transition to the buyer. Next slide, please. You know, without a proper transition of roles for a retiring partner, the intangible value is dramatically diminished. So I'll give you an example, and hit the final click on that slide, please. Give you an example of a firm I'm working with right now. We started about 1.5 years ago putting together a new financial arrangement, a new partnership agreement, because the agreement that had been in place didn't reflect the current situation. It's a 3-partner firm. Well, they came to me the other day, and a very key component of that plan was they needed to acquire the talent necessary to create a strong internal succession team. So we talked about who was out there and who they've been talking to, and we worked out a plan to hire someone off the street that they were in negotiations with at a pretty high cost. We put together a plan for promotion of a manager to partner level, which they did as soon as we got done with our retreat, and talked about the further steps they needed to take with respect to building their internal succession team. Well, they came back to me just about a month ago and said, you know, we need to revisit this because it turns out we never signed the agreement. A couple of us aren't comfortable with the terms we came up with, and we really need to revisit this. And I said, well, let me ask you this. Where are you on building your succession team? Turns out that the person they promoted to partner has already left. Turns out that the person they hired off the street that was supposed to be the superstar hasn't turned out to be nearly as strong as they hoped they would be. And as a result, they have no new partners in the firm and no new people to even work with, and now we're 1.5 years further down the road. And my point to them was, you know what, the financial agreement we're talking about is kind of a moot point here, because as it turns out, you've got one guy that's going to retire in 2 years, and you've got another guy that's going to retire in 5 years, and the third guy is incapable of running the firm on his own. So why are we even talking about the financial arrangement when we don't have, you know, any way of transitioning these duties to maintain the firm? Next slide, please. So what do you need in order to make a transition plan successful? The first thing is you've got to have a succession team in place with the capacity to take over for retiring partners. Now keep in mind that capacity in a well-run firm, you don't have excess capacity lying around. So this is really not something where you can just say, hey, so-and-so's got an extra 1,000 hours, I'll give them these clients. Normally it's a matter of a trickle down throughout the entire firm as you create a different set of duties for almost everybody so that they can assimilate or they can absorb the responsibilities of someone that's walking out the door. But making sure you've got an internal succession team with capacity, next click, understanding how to replace a retiring partner's duties. You're not replacing just a body, you're replacing a role. So for instance, if you've got somebody who has strong administrative responsibilities, somebody's going to have to do that. Now sometimes we'll replace that person with a non-partner. Maybe it's time to bring in a COO or a CFO type person. if the firm's large enough. But if it isn't large enough, then somebody's going to have to take on those responsibilities. If you have someone who has specialized technical responsibilities, for instance, this firm I just mentioned, one of the partners is leaving, does a lot of governmental audits. They need to find somebody who can do governmental audits. Next click, please. And you have to leave enough time in the transition so that a retiring partner can have an active involvement in transitioning their most key relationships, which are oftentimes partner or clients. Your goal should be to make sure that the day that that partner walks out the door, it's a non-event for all the key relationships. So rather than the clients being concerned about what the future holds, they've already made the transition to somebody within the firm, so all they can do is say, hey, congratulations, I've enjoyed working with you. I'm going to say something that's pretty counterintuitive here, and many of you may not agree with it as soon as I say it, but the longer term and deeper the relationships a client has with a partner, the easier it is to transition those relationships. Why is that? Well, it turns out that many of your best clients are clients you've had for 25, 30 years. And they'll do anything you tell them to do. They confide in you in things that aren't even financially related. They might have told you about a divorce they were anticipating going through or a problem they were having with a child. And you're their most trusted advisor. Well, your last piece and your best piece of advice is who your successor is going to be. So if you're in a situation where you have somebody in place that's competent, you can support the fact that you're transitioning your duties to that person, your client will follow along. And it's our experience that that's actually the easiest type of transition to make as long as you have active involvement from the partner who's making the transition. Next slide, please. One of the tools that we use in assessing whether or not the firm has the right people in place for succession and when they need to be in place is this chart. There's two different kinds of ways that you replace a partner. One is called role reallocation. In a role reallocation, we're not going to have to hire another body to replace a partner. We have enough excess capacity. The duties that we're trying to replace are not that complex to where those responsibilities can be spread amongst the rest of the partners. So for instance, a partner might have a $750,000 book of business, and we have 4 partners in the firm who feel like, you know what, I can take on a portion of that book of business. I'm okay with that. That's a role reallocation. A role succession is when we don't have that kind of capacity, or there are special duties that nobody else has in the firm, and we're going to need to replace a body with somebody who's going to be eventually walking out the door. So what we do is we go through and look. In this firm, we have 5 partners, and we're saying, within the next 1 to 3 years, the partner who's likely to leave first is a role reallocation partner, meaning we don't need to hire anybody to replace him. But then in the next 4 to 7 years, we've got 2 partners leaving, and both of those we're going to need succession for, which means we're going to need to bring in at least 2 more bodies in order to replace that person and go through a proper transition. And then, of course, the last 2 people, one's a role reallocation and one's a role succession in this example, and they're more than 8 years out. Well, this is a way of helping us assess what we need to do and when we need to do it in order to get our succession team in place. In this case, needless to say, we're kind of in an emergency situation because as early as 4 years from now, we're going to need somebody, 2 people in place to replace these 2 partners. So rolling that back, we need to get busy now to get those bodies in place. Next slide, please. Your transition plan should require that you leave at least 2 years to transition fully the duties of a retiring partner. It's our experience that in some cases clients can take a lot longer than that to transition. In some cases they can take a lot shorter time than that to transition. Typically an individual tax client, for instance, who's individual only, may not take 2 years to transition properly, or maybe the risk isn't, because of the size of the client, the risk isn't so significant that you even care. But if a client that you maybe see, infrequently throughout the year, but it's a large client, say an audit client, 2 years is actually only 2 cycles of service may only in fact be 2 visits by a partner. So 2 years appears to be kind of the minimum amount of time that you need to allow for a proper transition. Next click, please. Which means that you have to have that partner's replacement in place by that time to properly execute this plan. So if we start with, okay, I'm going to need this transition plan to be completed in 2018, I'm going to have to start that plan at least by 2016. When do I have to make sure that I've got the people in place and develop to a point where they can take over those responsibilities starting in 2016? So you've got to roll back from that to see when it is that you need to get the people in place. Next slide, please. Nikki, next slide, please. Thank you. One of the things that you can, one of the extra pieces of material you can access from us is a monograph titled Internal Succession Readiness that you can acquire through our website, and it's available for access there. Next slide, please. Briefly at 50,000 feet, what are the keys to partner development? And the reason I say that is because we really don't have time today to get significantly into this. But there are 3 things that I think are important for you to consider as you think about partner development and building your internal succession team. One is, I think it's important to know what it takes to be a partner in your firm. We recommend that you have kind of a job description for a partner in your firm so that you understand what the key areas of performance are to be successful as a partner. And those things can be, none of this is rocket science, but some of these things can be, for instance, technically competent in a certain particular field or specialty, good at training and developing people, leadership skills, ability to manage a certain size book of business. Your firm might be $500,000, it could be $2.5 million. Effective at dealing with billings and collections, ability to maintain trust within your client base so that they will, in fact, follow you and maintain the relationship with the firm, ability to manage and to develop other people. So normally you want to go through this list, and if you have this list in a formal way, first off, it allows you to get agreement amongst all of your partner group as to what's important, and it gives you an ability to assess the people on your team to make sure that they are, where they have gaps in their performance and where they're actually performing at a level that's going to be required, and that can lead to a proper development plan for those people. If you want an example of a list of the characteristics that we've seen other firms use, just let us know at the end of the presentation, and we can send you a list, an example list of what this looks like. The next thing you might want to consider is using income partner status as a final proving ground or a final development step in the process of becoming a partner. We're seeing this being used more and more frequently in the profession now. Many firms have as many as 1/3 of their partners are now income partners. Some of those, sometimes they're income partners on a permanent basis because that's just the status that they'll always be at. But oftentimes what we're seeing is that rather than promote directly from a senior manager position to an equity partner status, there's an interim step. Sometimes that can last as long, usually in a 2 to 3 year time frame, in which time you're really finding out, does this person really have what it takes before we make the final step and make them an equity partner. Then next click, please. Finally, you want to make sure that the financial arrangement for bringing a new partner into the firm is a win-win opportunity. You don't want to be giving away the equity, but at the same time, you don't want to make it so unaffordable that someone can't afford or isn't willing to take the risk and can't afford to muster the resources necessary to become a partner. There's a lot of different tools for how to do that. We don't have time today to get into a lot of those in detail, but there's a number of different tactics that can be used. It depends obviously how your agreement is set up and on how you deal with that. But some of the tools would be using long-term vesting programs before someone vests in their interest in the equity of the firm. We can stage the equity in. We can set up tactics where we're splitting how much equity they own of the tangible equity that might be different than what they own of the intangible equity. So if you're interested in that, we can follow up with you after later down the road for your specific situation. Next slide. I think it's the polling question, Nikki.
Yes, that brings us to our first polling question. I'll go ahead and launch that now. So the question says, we have the talent on board to replace our owners who will be leaving in the next 5 years. And you can select yes, no, possibly, but they have a long way to go, or yes, but we don't know how to admit new owners correctly. So we'll leave the poll open just for a few more moments. Keep in mind that you do need to complete the polls in order to receive the CP credit. We'll give you just about 5 more seconds, and then I'll be closing the poll. Okay, the poll is now closed, and Terry, I'll turn it back to you.
Okay. Whoops. There we go. All right. In 2000, the PCPS division of the AICPA conducted a survey in 2008, succession survey, which was the first of its kind. And then in 2012, updated the survey. There were 509 multi-partner firms that responded to the survey. And the median size of those firms is about 4 partners, which kind of reflects the profession as a whole. We found most of these statistics to be consistent with what we expected. 46% of the firms that responded have a written succession plan in place. Now, there wasn't a lot of detail as to what that means, but it is some, in other words, it's some plan that would say we understand when our partners are going to leave, how they're going to be replaced, a partner development program, and so forth. 63% stated that they have succession challenges in the next 5 or fewer years. There's a companion survey that was done of sole proprietors, and in that survey, 65% of the sole proprietors that responded indicated that they were age 55 years or older, meaning that 65% were probably likely to retire in the next 10 years. And that reflects as well in this multi-partner survey, meaning that as we all know, our profession is pretty much run by older people. Their firms are owned by older people, and this is a problem not only in the CPA profession, but also in American business as a whole, because baby boomers, for the most part, are the owners of a majority of companies in the United States. So 63% of the firms said, look, we've got an issue here in the next 5 years. And this was the most surprising thing to me. 37% of multi-partner firms have no current agreement in which they know how they're going to pay partner retirement. That may be the case with some of you on this call. Next slide, please. When you look at some of the benchmarks for internal valuation, one of the things that always seems to come up is pre-funding. I get that question a lot from firms. And what we found is that about 20% of firms do any kind of pre-funding at all, and I think oftentimes all that is probably participation in a 401k plan. So they think of the partner as saying, well, yeah, I have some of my retirement pre-funded through a 401k plan. We actually see very, very few firms, only 10%, that fund even 50% or more of a true partner buyout retirement program. Next click, please. The reasons for this, I think, are 2 main reasons. If you pre-fund a partner buyout, either the retiring partners are going to be paying for their own buyout, or next click, if they're not paying for it, then the other partners are going to be taking a step back in compensation for a significant period of time while they pre-fund the other partner's buyout. So the economics of pre-funding can be very difficult for firms to deal with. On the one hand, you're thinking, gee, I've got this asset that I've built up that's worth a lot of money. I own it. It's my interest in the partnership. Why should I pay for my own buyout? On the other hand, if you're in a situation where you're a younger partner who's going to be paying for other partners' buyouts, you can say, look, I'm trying to make some money here. I can't be doing both of these things at the same time. And I think both of those conflicts lead to very few firms that actually pre-fund buyouts, and I think that probably makes sense, actually. We see a lot of agreements work where pre-funding is not a significant portion of the agreement. Next slide, please. Going back to the PCPS survey, there are generally 3 usually three ways that firms structure their buyouts. One is, and about 37% of the firms that responded to the survey indicate they use a multiple of equity, meaning if my firm is a $3 million firm, I set a theoretical value on that $3 million. Let's say I use 1x, so that's $3 million. And if I own 30% of that firm, then my ownership interest is worth $900,000. So that's the multiple of equity method. The second method would be managed book of business. So each of us manage a distinct book of business. My book of business is $750,000. If I'm using 1x as my multiple, valuation multiple, then my buyout is going to be $750,000 when I leave. And the third method is a multiple of compensation. So if my average compensation, let's say that my three highest years in the last 5 years, my average compensation was $300,000, and I'm using a 3 times multiple, then my buyout would be worth $900,000. 25% of the respondents, of course, did something other than those three. It could be something like a stated value. It could be something that's a complicated formula they've come up with somehow. But the majority of firms are using one of those three tactics. Go on to the next slide, please, Nikki. Next slide. Thank you. Of the firms that are using a multiple of book or equity, next click. Once you click down through till you get to almost 30% use. Less than 10% used more than 100% of revenues. That can be surprising because in a lot of markets you see external valuations that are over 100%, but within internal deals, very few firms use more than 1x. About 40% use 1x as the basis for their valuation, and about 30% use between 75% and 100%. Now, what we're seeing nationally as a trend is the internal valuations are coming down. And I think this reflects primarily the fact that so many partners are going to be retiring in the next 10 years in so many firms that the belief is that if we push on this too hard, it could end up destroying the firm. The firm just won't be able to afford it. There's too much going out the door. So we definitely are seeing a trend towards lower valuations. Next slide, please. For firms that use compensation, that's as far as it goes. For firms that use compensation as the basis for the valuation, about 40% use 3 times. And that was when this concept was first introduced, several decades ago. That was generally what all firms were using, was 3 times. We are seeing, again, a reduction in multiples. About 15% of firms use 2.5 times, and between 15 and 20% use 2 times. Now, the old 3 times was actually just a different version of using 1x for the revenues. Because if you think back to the traditional way of looking at the profitability of an accounting firm, 1/3 of the revenues would be in partner profits. 3 times 33% is 1x, and so there was just a different way of expressing that same 1x. The difference, of course, is that the allocation of value in a firm that uses compensation versus equity can be dramatically different. It's not unusual to see firms where equity ownership is extremely imbalanced. I've seen firms where one partner owns over 90% of the firm, and as many as 5 or 6 partners might own the rest. You'd never get away with compensation being allocated that way. So you can have a significant difference in the allocation of value in a firm that uses equity as the basis for its allocation of value versus compensation. Of course, that can lead to, when you have equity that gets out of balance like that, that can lead to a lot of problems. And in fact, we've worked on several mergers because of the tension that created in the partner group. Next slide, please. Given that, internal agreements use a multiple anymore of as little as 0.8% or 0.8 times revenues, why is it that external sales appear to be valued at a much higher level than internal deals? I actually ran into this recently with another client where we had done, I think, 2 mergers with them, and we're working on a 3rd. And they weren't actually mergers; they were really acquisitions. They were, situations where somebody was selling their firm and would be around for 2 or 3 years and then would be leaving. So we really, even though it looked like a merger, we treated it as an acquisition contractually. It's called a 2-stage deal, which is a tactic that we use, and you can learn more about on our website. But one of the partners was having trouble reconciling, saying, look, why are we paying this guy 1 times revenues when in our agreement we get 3 times compensation and our profitability is only 0.25. I'm only getting 0.75 for my interest, but you're asking me to pay this stranger 1 times. Well, once you click down through until you get to external deals are designed. First off, external deals are the outcome of a bidding process, and so you've got competition for the deal typically, whereas in an internal deal there is no competition. There's only 1 buyer. The most important aspect in my mind is that an internal deal is actually a put option. So just like if you owned a put option in the stock market, what you're doing is you're forcing a buyer who has a contract with you to acquire an asset from you under certain circumstances, and they're forced to do it contractually. And that's in essence what an internal acquisition is the certain partner group is forced to buy the interest of an outgoing partner. So that put option, just like in the stock market, there's a cost to acquiring a put option. There should be a discount that's advanced for the contract of one partner buying out another. You have a different package of terms. Typically, the most important part of that is that in an internal deal, oftentimes the price is fixed at the date of retirement, whereas in an external deal, oftentimes the deal is based on retention for as many as 5 or 6 years following the acquisition. Internal deals are designed to keep the firm viable, so you've usually got some intangible reasons for lowering the price as well, whereas external deals are designed to maximize the liquidation value of the firm. Next slide, please. The right financial arrangement is we need to tie the transition plan and the execution of the transition plan to the payout, to the obligation to the partner, to make sure that our transition plan, if we fail to execute the transition plan, then that is reflected in the buyout. Next click, please. Trusting that the transition plan will be executed is an important component in most agreements. So if my agreement, and most agreements do fix the price at the date of retirement, there's an assumption in there should be an assumption in there that we have a transition plan in place and that the people that are required to execute the plan, in fact, will do it. Of course, the successors, the internal successors in the firm, will do what they're supposed to do to take over the responsibility, as well as the transitioning partner will, in fact, relinquish those responsibilities and transition to the successors. Next 2 clicks, please. Sometimes you really can't take that chance, though. For instance, there's not enough time for the transition. If a partner comes in and unfortunately your agreement allows for, say, a 90-day notice period on a retirement, then you don't have a long enough time to transition, and it's not appropriate in a situation like that to have an agreement where the price is fixed potentially. Could be that there's special duties that a particular partner has that we're not sure we can replace. An example of that might be a litigation support practice where this partner is an expert witness and really no one else is going to hire someone else to do that kind of expert testimony. Or it could be that there's just a very large client that this partner is responsible for, and we just can't take the risk that that one client isn't going to transition. So we need to set up a post-retirement contingency. When you do set up a post-retirement contingency, we oftentimes recommend that usually covers 2 years unless it's for an extremely large client. So I've worked with firms, for instance, where one client might be a $500,000 a year client for a partner who has $1 million book of business. We oftentimes would set up that deal where the payout is based for that client is based on strictly the retention of that client over, say, a 5-year period. Next slide, please. When looking at the financial arrangement, though, the thing that is most important, I think, is to make sure that it's internally affordable. And we use a term called backwards valuation. Next click. A backwards valuation makes sure that you're rewarding your retiring partners fairly for all the years of sweat equity that they've built up. But, next click, you're not expecting your remaining partners to borrow money or to take a step back in compensation in order to execute the plan. So, how does this sound? Going to your partners and saying, hey, I've got a deal for you. For the next 5 years, you can take over all the duties that I've been responsible for, all my clients and so forth, which means you're probably going to work harder. And oh, by the way, you're going to make a lot less money because you're going to be paying me off, or you're going to need to go out and borrow money in order to pay me off. I mean, it doesn't sound like a very compelling opportunity, and it's not something you could actually get done in an external deal either. I mean, no buyer is going to do a deal like that. And yet I've seen agreements where, because of the way they're structured, that's in effect what's going to happen. So what that can lead to, of course, is unmotivated partners who are unwilling to execute the plan and stay with the deal. Let's go to the next slide, which I think is a polling question.
Yes, that brings us to our second polling question. I'll go ahead and launch this here. For this polling question, it says, I think the value and terms used for buying out owners in our agreement are, number 1, too expensive for the firm, number 2, not good enough for the retiring owners, just about right for the firm and retiring owners, we don't have an owner agreement, or I don't know. So please take a few moments to select from those choices. Again, just a reminder that all 3 polling questions do need to be answered in order to receive the CPE credit. We'll keep it open just for about 5 more seconds. And I'm going to go ahead and close the poll and turn it back to you, Terry.
Okay. I'll tell you that there's a couple questions we've gotten. One is, if long-term retirement is too expensive, doesn't it make sense to quit early? And the second is, what does maximized liquidation value mean, in the last couple of slides? I'm going to address both of those issues, I think, in the next set of slides. So hopefully, we don't get ahead of ourselves here, but I think we're going to find that both of these issues will be addressed. So how do you know that you've got the right financial arrangement? What is a backwards valuation? Well, the first thing to consider here is that the available capital that you have to execute the financial terms of a partner buyout is that partner's foregone compensation. And with that foregone compensation, please click through. With that partner's foregone compensation, you're going to do 3 things. You're going to pay off their partner based on the agreement. You're going to have to replace the partner, and then you want to make sure that you're leaving some upside for the remaining partners in the firm for assuming the obligation and all the extra work they're going to have to do. So how do we do that? Go to the next slide, please. First thing to keep in mind here is that there's a basic assumption regarding compensation in any kind of partner buyout, and that is that an owner is either an owner and earning owner-type compensation and still owning their interest in the firm, or their owner's being bought out, and if they're continuing to work for the firm, it's on an entirely different basis, more like a per diem arrangement. The difficulty that you have is when you're trying to do both at the same time, because you just don't have enough dollars to go around. Owner compensation generally distributes all the profits of the firm. And most firms operate at a break even once they've paid their partners, their owners. And so if we're continuing to pay full-time compensation, owner-type compensation, to a retiring partner, there's nothing left over to pay them off with unless the other partners take a cut and pay. So the first thing we have to do is we have to segregate, how we're going to get paid based on what our ownership relationship is with the firm. And I know that may sound basic, but I've seen a lot of situations where that becomes a problem. Let's go to the next slide, please. So let me give you an example here. You click through. Retiring partner, let's say, is making $300,000, and this would include benefits and distributions and everything. This is the entire package that the partner would earn. We might decide that to replace that partner would take about $120,000. Now, typically, the way I would do that, look at that, is I would look at their billable time, and I'd see, what are they producing in the way of billable dollars, and if it's $300,000, then, compensation plus benefits might be about $120,000 for a person like that, or for several people like that. You're not going to replace a $300,000 partner with another $300,000 partner. First off, you can't afford to do that. It's just not even necessary. Typically, you're going to have a senior partner who's making a lot more money than a junior partner who might be doing the same, or capable of many of the same duties. And so you've got some leverage there that you can create. So in this example, we've got $180,000 left over to work with for a partner that was generating $300,000 in compensation. Next slide, please. In this case, let's assume that the firm volume was $1.9 million. We're using an equity type arrangement for paying out partners. This partner owns 45% of the equity of the firm. In this case, this partner is only making $275,000. They also have a $175,000 capital account. You're going to pay them out one times volume on their 45%, which is $855,000. So that's $171,000 a year for 5 years. And the cost of the replacement resource is $125,000. So let's go to the next slide, please. Click through the next slide, Nikki. So your year one cash flow is going to be $275,000, which was the partner compensation, less the $125,000 of replacement resources, leaves $150,000. The first thing we're going to do is pay off their capital account. Well, that's $175,000. The next thing we're going to do is pay the first year's retirement benefits, which is $171,000. So in the first year, our firm is going to generate $146,000 in negative cash flow from this deal. And then for the next 4 years after that, the negative cash flow is going to be $21,000 because we're only going to have $150,000 to work with, and we owe $171,000 a year. This is not a very compelling plan, obviously. So the other partners are going to look at that and go, wow, this is great. I'm either going to go borrow a bunch of money, or I'm going to make a whole lot less money than I intended, plus I'm going to be working a lot harder. Next slide, please. So as an alternative to that, we restructure the deal. And potentially what we might do in this case is pay the capital instead of all up front, paid over 5 years. Maybe you add some interest to it. And I've seen that done oftentimes when the capital is paid out over an extended period. There might be an interest factor paid to it or added to it. The second thing we might do is pay, instead of paying the retirement over 5 years, let's pay it over 10 years. Now let's see how that works. Let's go to the next slide. For years 1 through 5, while we're still paying the capital, we've still got the $150,000 to work with. Now instead of paying $175,000 in lump sum, we're going to pay $35,000 a year. And instead of paying $171,000 per year on the retirement benefits, we're going to pay $85,500. So now we create $29,500 of positive cash flow in the first 5 years, and then in years 6 through 10, we create $65,000 of positive cash flow. So as you can see, now we can say to our partners, don't worry about it. We can afford to do this because it's a positive outcome for the firm, and the retiring partner really hasn't given up that much. And obviously they're waiting longer to get their money, but typically, that's not really an issue. That's not as big an issue as it is if the firm can't afford to pay them at all because it's gone out of business, or the partners are left because they are not motivated to execute this plan. Let's go to the next slide. It's a polling question, I think.
Yes, that brings us to our third and final polling question. I'll go ahead and launch that now. This polling question asks, in the future, our firm will most likely replace retiring owners internally and stay independent, merge another firm in to strengthen our succession team, or merge upstream into another firm for succession. Eventually sell the firm is the final option. So take a moment here and select from those choices. And just keep in mind that this is the third and final polling question and that you do need to have answered all three in order to receive the CPE credit. I'll give you just a few more seconds in order to do that. And then I'll go ahead and close the poll and send it back to you, Terry.
So let me go back to the two questions that were asked and then also address the third question that's just come in. First, if long-term retirement is too expensive, doesn't it make sense to quit early? There's no reason for long-term retirement to be too expensive. As I just tried to demonstrate through this example, it's possible to structure the terms of your deal in a way that it's not too expensive and that it's self-funding. So there shouldn't be, if you have a properly structured deal, there shouldn't be any concern amongst the group as to whether or not you can afford this. Now, whether or not you have a strong enough succession team to maintain the firm, whether or not you've got enough people in place to replace the partners that are going to be leaving, that clearly can be an issue still. But whether or not the terms are affordable once the succession team is in place shouldn't be an issue. One of the governors that you can use when you have multiple partners retiring, of course, is limiting the amount of retirement payments that can go out to retired partners as a whole. And typically, we recommend that they not be permanently reduced, but in fact be deferred, so that the firm can assure that it has enough cash flow to not only pay retired partners, but also keep current partners compensated well. The second question, what does maximize liquidation value mean? Well, what I'm saying is that as a seller of the firm, typically the long-term viability of the firm isn't as much of a concern of yours as it is when you're retiring from a firm. So when you sell your firm, you understand that you're selling assets, and even though it might be treated as a consulting agreement, you're selling assets, and that you're kind of giving up on the legacy of the firm, that somebody else is going to become your successor. So normally the financial terms, the financial outcome of the deal becomes more important to you than some of the intangibles that you have in an internal deal. And finally, the third question we've got is buyout value different than death payment. Normally in a death arrangement, because of buyout due to death, first off, hopefully you've got insurance, because you have the same issues with respect to transition when someone dies as you do when someone just quits. You usually have a little bit of a sympathy factor that's to your advantage, but you still have the problem of an abrupt transition of relationships. And so insurance can overcome the risk that poses. But other than that, oftentimes we see the death benefit in most agreements be the same as a normal retirement. Okay, so what are some of the other agreement term issues that we have to deal with? One is tax considerations. In the worst case scenario, and I'm working with an agreement right now that has this feature, all the payments are treated, it's a corporation, it's a C corporation, and all the payments are treated as treasury stock. So as a result of that, in order for the firm to generate enough cash flow to generate the cash flow necessary to buy the stock, they have to earn about $180 worth of earnings to have $100 of after-tax dollars left to buy the treasury stock. That's a horrible plan. I mean, we're going to fix that. But I've seen a number of agreements where, in C corps, where a lawyer drew them up and didn't think about the tax consequences, and in essence treated the whole thing as a treasury stock transaction. Most agreements that we see are the payments are treated either as deferred compensation in the case of a corporation, or treated as retirement payments, guaranteed payments to partner in the case of a partnership, and therefore deductible as paid. There's some interim steps you can use where you treat the payments as the acquisition of a partnership interest, which can create capital gain in a 15-year amortization period for that asset, or you can actually create a goodwill asset if you have the right type of arrangement in place. It's possible to buy buy the client list from a shareholder employee. That's a little trickier step. And both of those, of course, whereas they create a nice capital gain for the recipient, it creates a more of a cash flow burden for the firm because they have to deduct the payments over 15 years. Normally, we don't see interest on deferred payments. I recognize that if you do have an asset sale, that there's imputed interest that you have to factor in. But when you are dealing with interest on deferred payments, for instance, a 5% interest rate on a 5-year payout increases the price by 13%. So whereas your intention might have been to have a 1x type deal, if you add 5%, a 5% annual interest rate on that, you really got a 1.13x deal. So it can significantly increase the cost, and if you're going to add interest in, you need to consider whether or not you need to reduce the underlying principal payments. I mentioned the cash flow safety net already, which is where we make sure that the cumulative payments made to all retired partners don't bankrupt the firm. And then, of course, restrictive covenants are really important with respect to any kind of buyout. I've seen a situation where a firm actually had a 1-year non-compete associated with the buyout of a partner. This particular partner wasn't necessarily an upstanding person, and after the year started taking the clients away from the firm that he had worked on while he was there. So at the same time he was taking clients, he was being paid for those clients in effect, and the result was a lawsuit. But the best thing to do is to create restrictive covenants to cover at least the payment period, so that you're not running into a situation where clients are leaving the firm at the same time a partner is being paid for them. Let's go to the next slide, please. Some of the agreement issues that you might run into are if your multiple is too high. Let's say if your multiple is in excess of 1 times or 3 times, it's probably suspect. Payout period is too short. If you've got an agreement that calls for a 5-year payout, it's probably not going to work. It usually needs to be longer than that, unless the multiple is low enough. Front-end loaded payment streams, which includes paying out the capital. If your capital is if you're trying to pay your capital out on the front end, usually that's going to create a lot of problems if you're also at the same time paying retirement. As I mentioned, interest can be an issue with deferred payments. A significant imbalance between the equity and compensation for super and majority partners. Again, if you've got a long-term situation where someone's owning, a significant portion of the firm, but it doesn't reflect the actual value that they're controlling, that usually can lead to a lot of tension and potentially a breakup of the firm. And then I mentioned the tax treatment issues. Finally, next slide, please. One of the things to think about is if you've got a situation where you feel like, we're just not going to be able to pull this off. We don't have the succession team in place. Consider a call-out sale. A call-out sale can be identifying a group of clients or a service area that you can sell off separately. Maybe it's even considering, a partner leaving the firm and finding a different buyer, leaving the rest of the firm intact, but taking a book of business or a group of clients and going to a different firm to find a firm that can handle the buyout easier. Or, of course, your worst case, not worst case, but your final consideration would be an upstream merger in the event that you just feel like, we just can't do this. This is going to be too hard to do. With that, I'll turn it back over to Nikki.
Right. Just wanted to remind everyone that right when the session ends, there will be a brief survey that pops up. It's in that survey that you can request additional information, including some links to articles on our site that Terry's recommended. That's also how you can request a PDF version of the slides. And then separate from that, I will be emailing you a link to an evaluation, and that is the one that's required in order to receive the CPE credit. So look for an email from me here shortly this afternoon. If you have any questions, you can email the email address there, and I will reply to you. And there were a couple questions that we didn't get to because we didn't have time, but I will get those to Terry, and he can follow up with you individually. Right, with that, I just want to thank everyone so much for attending, and we hope that you'll join us for a future webinar. Thanks.